Are you struggling with debt and looking for ways to get out of it? In the modern world, it's all too easy to find ourselves in a financial bind. Debt, like a shadow, can follow us everywhere, casting a dark cloud over our lives. It's a significant problem that affects millions of people. But it's not just the numbers that matter, it's the impact it has on our lives, on our peace of mind. Debt can feel like a weight constantly pressing down upon us, but it doesn't have to be this way. Managing debt effectively is crucial, not just for our financial health, but for our overall well-being. It's time to break free from the shackles of debt and reclaim control of our finances. And this is where we come in. In this video, we will provide you with practical tips and tricks to get you out of debt. First, we need to understand what debt is and how it works. Debt, in its simplest form, is money borrowed by one party from another. But it's not just a simple exchange. What makes debt a little more complex and at times intimidating is the concept of interest. Interest is the cost of borrowing money, and it's how lenders make a profit. It's usually expressed as a percentage of the total loan, and it can be calculated in various ways. But for now, let's just say that the higher the interest rate, the more you'll end up paying in the long run. Now, there are several types of debt you might encounter in your financial journey. First up, we have credit card debt. This is a form of revolving debt where you borrow money to make purchases and then pay back either the balance in full each month or over time with interest. Next, we have student loans, a type of installment debt used to pay for education. These loans usually have lower interest rates, but they can pile up quickly, especially for those pursuing higher degrees. Then there's the mortgage, a loan taken out to buy property or land. These loans are typically large, and repayment is spread out over many years, usually 25 to 30. And let's not forget about auto loans, payday loans, and personal loans. Each has its own terms and conditions, interest rates, and potential pitfalls. But regardless of the type, all debt has one thing in common: it creates a cycle. You borrow money, then you pay back more than you borrowed due to interest. If you're not careful, this can lead to a cycle of borrowing more and more to cover previous debts, trapping you in a financial hole that can be hard to climb out of. This cycle of debt can have a significant impact on your personal finances, limiting your spending power and potentially causing stress and anxiety. Now that we understand what debt is, let's dive into how we can manage it. One way to manage your debt is through a debt consolidation loan. Debt consolidation, what is it? Well, in simple terms, it's a financial strategy that merges multiple debts into a single loan. Imagine yourself juggling several balls, each ball representing a different debt. Now, instead of juggling multiple balls, you're only dealing with one. That's what debt consolidation does for your debt. So, how does it work? Let's break it down. You take out a new loan, usually with more favorable terms to pay off your existing debts. This could include credit card debt, student loans, or other personal loans. The goal is to simplify your debt management, often by securing a lower interest rate or reducing your monthly payments. The benefits of a debt consolidation loan are numerous. First, it simplifies your finances. Instead of keeping track of multiple payments, you only have to worry about one. Second, it can potentially lower your interest rate, saving you money over the long term. Lastly, it can improve your credit score by showing lenders that you're committed to paying off your debts. Now, where can you get a debt consolidation loan? Well, many financial institutions offer this service. Companies like LendingClub, Prosper, and SoFi are known for their debt consolidation loans. These companies offer competitive interest rates and flexible repayment terms. However, it's essential to shop around and compare different offers to find the best fit for your needs. But remember, while a debt consolidation loan can be a lifeline for those drowning in debt, it's not a magic cure. It's merely a tool to help manage your debt. It's important to pair this strategy with responsible financial habits, like budgeting and saving. And remember, it's crucial to address the root cause of your debt, whether it's overspending or lack of a steady income. A debt consolidation loan can be a great tool to manage your debt, but it's not the only option. Balance credit cards and 401k loans are other options to consider. Let's start with balance credit cards. Think of them as a magic wand that helps you consolidate your high-interest credit card debts into one manageable payment. They work by allowing you to transfer your debts from multiple credit cards to one with a lower or even 0% interest rate. It's an attractive option because it not only simplifies your payments but also potentially saves you a lot of money in interest. However, it's not all sunshine and rainbows. It's crucial to pay off your balance before the promotional interest rate period ends. Otherwise, you might find yourself facing an even higher interest rate than before. Now let's talk about 401k loans. Your 401k is your retirement nest egg, but it can also be a lifeline when you're drowning in debt. A 401k loan allows you to borrow money from your own retirement savings. One of the benefits is that you're essentially paying interest to yourself. However, there are risks involved. If you lose your job or leave it, the loan often becomes due much sooner than expected. And remember, the money you take out won't grow with the market, potentially leaving you with less when retirement comes around. Both balanced credit cards and 401k loans can be effective tools when used correctly, but they're not without their downsides. It's important to fully understand the terms and risks before diving in. And remember, these are just tools. They won't solve the root cause of your debt. That requires a commitment to change your spending habits and maybe even your lifestyle. To recap, balanced credit cards can help you consolidate high-interest debts and potentially save on interest. But be wary of the end of the promotional period. 401k loans can be a lifeline, but they come with risks, including a potentially smaller nest egg come retirement. These are just a few of the many tools available to help you manage your debt. Increasing your income can also help manage your debt. Now you might be wondering, how can I increase my income? Well, that's where the concept of a side hustle comes into play. A side hustle is an additional job or venture that brings in extra income beyond your primary job. This might be something you're passionate about, like photography, writing, or even selling handmade crafts. Or it could be something practical, like driving for a rideshare service or renting out a room on a home-sharing site. The beauty of a side hustle is that it can provide a significant boost to your income, which can be used to pay down your debt faster. It's like adding an extra gear to your financial engine. And the best part? You're in control. You decide when and how much you work. But what if you're a business owner? You might think, I don't have time for a side hustle, I'm already hustling with my business. Well, good news. You can leverage your business credit to manage your debt. Business credit refers to the ability of a company to obtain borrowed money. It can be used to finance business expansion or as a buffer for day-to-day operational expenses. Leveraging business credit can be an effective tool for managing and ultimately reducing debt. It allows you to consolidate your debts into one manageable payment, often with lower interest rates. Moreover, it can help improve your business's creditworthiness, which is beneficial for securing future financing. However, it's crucial to be mindful while leveraging business credit. It's not an excuse to take on more debt, but a strategic tool to manage existing obligations more efficiently. It's also essential to ensure that the borrowed money is used responsibly to generate income or improve business efficiency. So, whether you're an individual looking for ways to make some extra cash or a business owner trying to navigate the financial landscape, remember that increasing your income and leveraging available resources can play a significant role in managing your debt. Remember, increasing your income is just as important as managing your expenses when it comes to debt. Another option to consider is a loan from a bank or credit union. Banks and credit unions are traditional sources for loans, but how do they stack up when it comes to getting out of debt? Let's dive into it. First, let's talk advantages. Banks and credit unions tend to offer lower interest rates compared to other lenders. This is particularly true for credit unions, which are non-profit institutions. This means less of your money goes towards interest and more towards paying down your debt. Another advantage is the variety of loan options. Banks and credit unions offer a variety of loans, personal loans, home equity loans, and even debt consolidation loans. This gives you the freedom to choose a loan that best fits your financial situation. Lastly, these institutions often provide financial advice and resources to help you manage your debt. They can guide you through the process, helping you make informed decisions. But it's not all sunshine and roses. There are a few disadvantages to consider as well. One major drawback is that banks and credit unions often have stricter eligibility requirements. You'll likely need a good credit score and a stable income to qualify. If your credit score has taken a hit due to your debt, this could be a hurdle. Additionally, the process of applying for a loan from a bank or a credit union can be time-consuming. It often involves paperwork and may take several days or even weeks for your application to be processed and approved. So, how does one go about applying for such a loan? Generally, you'll start by gathering necessary documents such as proof of income and a list of your current debts. You'll then fill out an application either online or at a branch. Once submitted, you'll have to wait for the institution to review your application and make a decision. While this option might not be suitable for everyone, it's worth considering. It offers lower interest rates and a variety of loan options, but requires a good credit score and a bit of patience. As always, it's important to weigh the pros and cons before making a decision. Budgeting is a key part of managing your debt. It's like opening the blinds on a sunny morning, allowing you to see clearly where your money is going. It can be a bit daunting at first, but once you get the hang of it, you'll wonder how you ever lived without it. To start budgeting, you need to understand your income and expenses. Write down how much money you're bringing in each month, and then list out all of your expenses. Don't leave anything out. From the big stuff like rent or mortgage payments, to the small stuff like that cup of coffee you grab every morning on your way to work. Once you have a clear picture of your income and expenses, you can start to create a budget. This is where you decide how much money will go to each category of spending. Essential expenses like housing and food should be prioritized, while discretionary expenses like entertainment and eating out can be trimmed down or eliminated. But creating a budget isn't enough. You also need to stick to it. This is where the dedication part comes in. It's easy to get tempted by that new gadget or that fancy dinner, but remember, every dollar spent on non-essential items is a dollar not going towards paying off your debt. Sticking to a budget requires discipline. It's about making conscious decisions about your spending, and sometimes it means making sacrifices. But remember, these sacrifices are temporary. They are steps towards a debt-free future. There will be times when you might slip up, and that's okay. Don't beat yourself up over it. Instead, use it as a learning experience. Ask yourself why it happened and what you can do to prevent it in the future. Budgeting isn't just about cutting back. It's also about finding ways to increase your income. Maybe it's time to ask for that raise, or perhaps start a side hustle. Every little bit helps. Remember, managing debt is a marathon, not a sprint. Stay dedicated. It's not always going to be easy, but with discipline, determination, and a well-planned budget, you're on your way to a debt-free life. Getting out of debt might seem daunting, but it is possible. Let's take a moment to recap the key points we've discussed in this video. First and foremost, understanding your debt is crucial. Knowing what you owe, to whom, and under what terms, lays the foundation for your journey to financial freedom. Second, consider a debt consolidation loan. This strategy allows you to merge multiple debts into one, often with a lower interest rate. It simplifies the repayment process and can potentially save you money in the long run. Next, we talked about balancing credit cards and a 401k loan. By transferring your high-interest credit card balances to a card with a lower interest rate, you can reduce the amount you pay in interest. However, it's important to remember that this is a temporary solution. A 401k loan might seem tempting, but it should be a last resort due to the potential tax implications and penalties. We also discussed the concept of a side hustle and leveraging business credit. A side hustle can bring in extra income to help pay down your debts faster. And if you're a business owner, leveraging your business credit can help you manage your personal debt better. Then, we delved into bank or credit union loans. These institutions often offer lower interest rates compared to other lenders, making them a viable option for debt consolidation. Most importantly, we highlighted the power of budgeting and dedication. Creating and sticking to a budget can help you understand your spending habits and prioritize debt repayment. Dedication is key here. The journey to becoming debt-free isn't always easy, but with determination and perseverance, you can reach your goal. Throughout this process, remember to stay positive. It's easy to get overwhelmed and lose sight of your goal, but maintaining a positive outlook will help you stay on track. With the right tools and mindset, you can manage your debt effectively. Stay positive, and remember, it's possible.